night we got Plug Power reporting, and it's just spectacular. Their revenue was in line, but they missed on EPS with 33 cents loss versus 11, and the worst margins they've ever posted, which is saying something for Plug. The wrong kind of record. When your revenue, I guess, in line is fine, but if you're generating a massive loss to, basically they're buying hydrogen and reselling it for less than they paid for it, it kind of tests the definition of revenue. Like, what does that mean? To basically be a loss-making reseller funded by your shareholders. And it's similar to what they did with warrants with Amazon and Walmart. They were name dropping, but if you give customers warrants that are worth more than the products they're buying from you, what does that mean? Like, that's not really revenue. That's kind of a charity exercise. They go through some detail on their longer term green hydrogen plans. And when you do out the math of what they would actually sell that hydrogen for, it's like hundreds of millions of dollars of revenue at kind of a dubious margin. Not a very good margin, even on their what's supposed to be good margin. It doesn't match up at all against their 11 billion, enterprise value. So, like, the premise of doing that is stupid. There are already people who sell hydrogen very effectively. There's no market for what they're promising in any scale that matters, which is why when they announce projects, they tend to be unbelievably subscale. And also, it doesn't work out to justify their stock promotion, right? If you haven't spent time looking at it, like it just, none of it makes any sense. What they're promising is stupid. They don't give you any of the technical information you'd really need to evaluate what they're theoretically doing. And that's probably because it's, it is exactly what it looks like. So that remains I know it's gotten a bit of a bid back here with the rally in garbage stocks in response to falling rate increase expectations and whatnot. But I love the short side in this name.
That's one way to say it. The other way to say it is that the rally in garbage has been a function of hedge funds getting ejected from their seats. I mean, this is literally the worst part when your longs go down and your shorts go up. So again, if you take like Nikola and you take three managers that are ejected from their seat, pick three different pod shops, and they have to cover 100,000 shares each of Nikola, I mean, good night and good luck. The stock's going to be up. I mean, there's so many of these stocks that, again, the last stocks in a bear market, there's so many components to trading a developing bear market. During bear market bounces, the last stocks to go up are illiquid, higher short interest names where the weakest hedge funds cover last. That may not be taught that way in business school because nobody teaches short selling in business school. It's certainly not how to trade it. You're seeing like the biggest pieces of shit, really bounce towards the top of an NMR range and hang out there. And then, one day you're just going to wake up and they're down 5 to 10% in the day.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.